Now, in the statement, they are saying a couple of things. One, they don't see cuts until they're more confident that inflation is nearing 2%. So this is something that, despite the economic data being strong and inflation coming down, a lot of Fed speakers said, maybe we can afford to wait and see, because what they'd hate to do is cut and then have to raise again because inflation reaccelerates. So the key point here, they don't see cuts until they're more confident that inflation is nearing 2%. They say risks to their goals are moving into better balance. So that's another thing that we've been tracking. How do they think about the risk to inflation? Are they tilted towards the upside or the downside? Here they're saying they are moving into better balance. So that initial line, and if we can take a look minute by minute at the markets, is being viewed as hawkish. The S&P, which is already under pressure going into this because of pain in the tech sector, is now trading at the lows of the day, has slumped down to 1% as the key line. And again, as our former colleague Francis Hordelsky used to say, the first reaction can often be the wrong reaction. But the key takeaway from the initial read of the statement is that they are a little bit more hawkish, that they would like to see a little bit more progress towards that 2% target. And we are seeing further pressure. That's kind of the knee-jerk reaction right now to this statement. In about half an hour time, Jay Powell will begin a press conference. Well, he'll be peppered on all kinds of questions around the outlook, that first rate cut. I'd like to bring in Claudia Sahm, who is a former Federal Reserve economist and head of Sahm Consulting. And on the equity side of things, we've got James Demmert, the CIO of Main Street Research. James, as I mentioned, the knee-jerk reaction is to kind of see markets move lower. And that is just kind of the one line that I've keyed in on as the cause of that. Should we really be surprised, though, that the Fed is erring on the side of caution?
I don't think we should be, Amber. I mean, they've got this economy right where they want it, and I mean, good for them. They messed it up, going into the high inflation we had by waiting too long. But this time, I mean, they've pulled off what I would consider a miracle. You've got a resilient economy. You've got inflation, their favorite indicator, PCE, less than their actual target. It's no wonder that they're pausing. And this market selling off, I mean, let's wait for the presser, right? We have to see what the commentary is. But this is the beginning of a new business cycle bull market. And, these are driven by earnings. And those Microsoft, Google numbers are just a good example yesterday, even though we can talk about that further. But earnings are going to drive stocks here. I don't think investors should be expecting the Fed to immediately cut rates. They're going to be really careful. They've got it right where they want.
So the line, just to reiterate, that seems to be stoking some of the fears is that the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving substantially toward 2%. Don't we already have that?
As far as I'm concerned, we do. And I frankly think, they are very acutely aware that pushing rates too long, too far is going to bring on another risk, which is obviously a much weaker economy. The community bank in New York today, down 35% the stock, because the earnings miss was huge and they slashed the dividend. That could be one of those beacons for the Fed to say, okay, wait, we should be careful here about how long we want to stay, higher for longer. I do think they'll cut. But again, I think investors are being way too overzealous about how much and how soon. The Fed's got it where it wants. They're going to take their time and look for signs of when they really need to. And let's remember, when they start cutting, I mean, if they have to go in a hurry, they can just go big. They go 50 basis points if the signs are showing them that they need to. So I think they're doing the right thing here, Powell, by just being patient and let the data come to them.
I want to now bring in Claudia Sahm. Claudia, as I mentioned, the key statement that the market seems to be keying in on is that the Fed is looking to have greater confidence that inflation is moving substantially towards 2%. And James was hinting at the fact that, the Fed has maybe the luxury of time. They can wait to see how things progress, because even with where rates are right now, growth is remaining pretty robust. How are you thinking about that interplay?
The Fed, everything the Fed is doing right now makes perfect Fed sense. And yet it is absolutely not what they should be doing. They should be starting to cut interest rates gradually, but they should get it going. The idea that they have the luxury of time is misguided, frankly, because it's not just about the economy, the weakness. We've seen some signs in the labor market that things might be not quite as strong as they've been. And also the Federal Reserve works through financial markets. There are many interest rate sensitive sectors. We talked about the bank today, and they had some commercial real estate loans where you're really pushing it. A lot of the financial markets, some of these credit, they've kind of held it together and largely well because those interest rates will come down. The longer we push that out, the greater the chances the Fed, as it usually does, breaks something. And we don't want that.
You said the Fed should be cutting rates now. If you're looking at the commentary that many Fed members are saying, they're afraid of doing just that because they don't want to have to, and other strategists talk about this, they don't want to cut and then have to hike again because inflation went the other way on them.
Right, but it doesn't make any sense, right? The Fed makes adjustments. The world changes, right? Things could happen that could push inflation back up. Frankly, it is clearly going down to 2% right now. So what's the big problem of cutting 25 basis points? Something in the world happens. We have to raise it 25 basis points. Like, this is not that unusual, except no one at the Federal Reserve wants to be Arthur Burns. Right, we're back in the 1970s in their mind, and he did make mistakes in terms of particularly listening to Nixon in an election year and cutting. So I think there's all kinds of things going on, but it's more like psychological baggage at the Fed than it is like looking at their tools, looking at the world.
James, I'd love for you to pick up on this point that cuts should happen now, and the Fed shouldn't be afraid to, have to raise again. Wouldn't that introduce a lot of volatility for assets?
Well, let's try to hope that the Fed's not thinking about the stock market, although I think they do. I mean, the concern that I would have for them to be, so generous about cutting rates today or a lot in the next meeting. I mean, I definitely think they're going to cut in the next quarter or two. But my concern is you've got a very robust economy. You've got a tight labor market. And, in a world where we didn't even have any inflation, one would wonder why they'd be cutting. I mean, there's not a lot of reason here. Earnings are healthy. The economy is super resilient. I think the risk that they think, that they're probably concerned about is if we cut here, the market expectation might be, or even, a lot in the next meeting, market expectations may get way overzealous, if one could argue they haven't already. But also the economy could certainly, from these levels of pretty resilient growth, certainly bring the inflation rate back up. And you're right, they don't want to be Burns. I agree. I just think that here I think they're better off just waiting, and again, not a long time, but waiting for better data over the next few months.
Claudia, how do you respond to that, particularly on the labor market? Because this is where you spend a lot of your time.
Right. So first, I just underscore the Fed's job is the dual mandate. If inflation is going to 2%, and we saw last year a massive amount of disinflation with growth that was really good, we have productivity growth that looks really pretty good. So there's no reason inflation cannot come down with growth staying high. And they do have to pay attention on the other side of the mandate and the labor market. I think we've gotten a lot of information, like out of the job openings labor turnover survey, that things really are not as quote unquote tight, right? We don't see the hiring rate much above where it was pre-pandemic. That was a good labor market, but that wasn't what we've seen in the last few years. So I really think the Fed needs to keep the eye on the prize here and follow their job, as opposed to getting into thinking about the markets is really, I think, goes down a path they don't need to, particularly because the wealth effects of what we typically see people spending out of the stock market going into the real economy is really pretty small.
I just want to inject some more color coming out of the statement, because I know I've been mentioning that statement that seemed to have caught market participants a little bit by surprise, where they said they don't expect it will be appropriate to reduce the rate until they're more confident that inflation is moving sustainably towards 2%. So that was viewed as hawkish. I should also mention that they did kind of drop their explicit tightening bias, replacing the sentence of requiring any additional policy firming with something else, saying instead of policy firming, now they're saying any adjustments. So those adjustments could be up or those could be down, but kind of introducing that flexibility. So I don't think it's as hawkish as perhaps the market initially read this. But James, does this matter if you're an investor? If you think about the rally to all-time highs, and yes, it was concentrated in tech, but this happened on the backdrop of rate expectations being pushed out, right? A March rate expectations, for example, declined as the market rallied.
Yeah, I mean, it in some ways that makes sense. I mean, but to be honest with you, I think that the reason that equities have done so well from the low in October, let's say, of last year, is really earnings driven. I mean, there has been some incredible earnings that have been reported, even if one wants to pick the ratings out of the cake about, maybe Google's ad revenue wasn't as expected. These numbers are fantastic, and not just in tech, but across a lot of different parts of the market. So I frankly think that the Fed conversation is just overdone. I mean, they're finished. We know that on the hiking. And now it's just a matter of when they start reducing rates, and one could argue they should have done it today or next meeting. I don't think that matters. I think investors should be better off focusing on companies who have great margins. And I like the comment about productivity growth. One cannot ignore that the AI is real, and you're seeing it already show up in some of these technology companies. Productivity growth is going to be a key issue. It's going to be stronger than the last cycle, and that's going to make profit margins even stronger. So the Fed should be careful here, and the market can go up without the Fed needing to assist it every meeting and by cutting.